Let me take this opportunity to welcome you to our today's session. Remember the last time we were doing taxation of the business income. Today, I just want to do the conclusion of that topic by looking on the taxation of the partnerships. And when you look on our partnership, what we need to understand is that the partners are not taxed as per the requirements of the Tax Act. What we need to do to know is that it is the respective partners who pay taxes on partnership income together with other incomes based on their peer sharing ratio. So the computation of adjusted business the computation of the partnership income is similar to any other business, except that no transaction between the partnership and partners is allowed. So what are we supposed to be doing? Basically, when you are dealing with the partners, we are saying that salaries to partners are disallowable. The interest on partners' capital is also disallowable. Commission on bonus, commission or bonus paid to partners is also a disallowable expense. Drawings of goods by partners is disallowable. What we normally do, we simply adjust for unrealized profits by adding back the drawings at cost and deducting at selling prices. Now, the interest on drawing also is an untaxable income, and other incomes are not adjusted for the business income, but in the allocation schedule. So that is why we have said each partner is taxed on the aggregate of the following. One, any form of remuneration from the business. For example, we have salaries, bonus, and commissions. We also have the interest on capital. We normally let the interest on drawings. Then the profit share after adjusting for 1.1 and 2 above. So what do we normally do when we are dealing with the partners? We say the items are, however, include the allocation, and that is where we normally have the allocation schedule. For example, if we have two partners, we are dealing with partner X and Y. We have to be taking the salaries to partners, which are basically put to each partner. We also have bonus and commissions included for each partner. We have the interest on capital to the partners. We deduct the interest on drawings. Then we are going to be looking on the profit share based on the profit and sharing ratios. Now, we are going to be getting the adjusted profits. Once we get it for each partner, we are going to be taking other incomes, which we are going to be including here. We have the farming, for example, the rental income. We have employment income. Then we are going to be getting the total taxable income. Now, when you look at it, we are saying the following are not allowed. They are not an allowable expense. Any form of remuneration to partners, and I have already reiterated that earlier. We have the interest on capital and drawings. The following are not taxable income. The interest on drawings, the capital introduced, they are not taxable, sorry. So the capital introduced into the business, that is the thing that we stated earlier. So I just want to do illustrations here so that we can be able to understand how are we supposed to be dealing with these kind of problems. So I would like to start with May 2017 as I come forward to 2022. So let us do 20. Let me open my questions here. So let us look on my questions. So let us do our question. We move very fast. So the question is question 3B. We have been told that Wema Limited, Wema and Nenda have been running Wenda enterprise as a partnership, sharing profit and losses in the ratio of 2:3, and respective. So the following the statement of comprehensive income for the firm for the year ended at 4 December 2016. So we have been given a statement there. We have the sales. We have 2 columns there. Then we have expenses provided by the examiner as per the preparation of the preparation of income statements. Now from there, we are going to be having additional information as provided. We have been told the business was converted into a limited liability company trading as Dawadu Limited with effect from 1st October 2016 and retaining the partners, the directors of the new company. So the cost of goods sold include opening stock of 576,000, which was overcasted by 20%. Purchases of 2146,000 include of 16% VAT, and we have the closing stock of 675,000, which was undercasted by 10%. Now we are being told all the revenues and expenses accrued evenly throughout the year. They normally accrued evenly throughout the year. Now we are also being told that throughout the year, except for specific expenses relating to Dawadu Limited as a company. Number 4, we are saying that salaries and wages include partner salaries of 120 shillings. Next, we are being told that the legal expense comprised of the acquisition of company's title deed of 50,000, negotiating debenture stock, demand letters to customers, drafting MOA. Now, from there, we have been told that Wema was paid consultancy fees of 54,000 for installing CCTV cameras in the premises. Number 7, advertising expenses, including sign of 92,000. The other question we have been told, the other point we have been given is that we have been told that the sales figure was inclusive of VAT at the rate of 16%. We also been told the director's allowances include commission paid to Nenda of 60,000 shillings for negotiating a business contract. Required here, we have been told, separate statements of just the taxable profit of profit or loss for Wenda Enterprise Dawadu Limited for the year ended at 1st December 2016. And we have been told that we start with the net profit. Number 2, we have been told the tax payable by or refundable to Dawadu Limited for the year ended at 1st December 2016. Now, when you are being provided with these kind of questions, remember, examiner wants you to do the question concurrently. And the questions which you're going to be working on here should basically talks about, should be giving out a good insight about how we are supposed to be dealing with both the partnership and also dealing with a taxation of business income, because that is what is being is a jointly question here. So how am I supposed to be sharing, or how am I supposed to be tackling this question? Let me share my board so that we can be able to handle the question well. So in this case, we have been provided with a very simple question, and you can see already I have written the question. So what I just need is to do a title. So in this case, we are going to be writing our title here. We talk about Wenda Limited, Wenda Enterprises, and Dawadu Limited. Right? So the question that we are doing is for which year? We are being told to calculate the question for which year. We are discussing the 2016 taxable income computation. Taxable income or loss computation. So remember, in this scenario, we are dealing with two different companies. So the first thing that I just want to identify is when the company was converted in, when the partnership was converted into limited, and I can see it was from 1st October. So it means the company was operating 9 months, right, as a partnership. Then we also have 3 months operating as a limited liability company. So we have Kenya shillings there. We also have another Kenya shillings here in thousands of shillings. Kenya shillings here is a limited liability company, right? So we are being told we start with the reported profits. So we start with our reported profit, and when I look on our reported profits, I'm just going to be subdividing it. Remember here, we are supposed to be getting the net profit for 9 months as a partnership. So in this case, we are just going to be taking our profit there, 1105.5. I multiply by 9, divide by 12. Here we are getting around 829.125. Then I take the difference, which is 1105.5 minus my answer. We're supposed to be getting 276.375. Then we add, we're going to be adding disallowable expenses. Disallowable expenses. So in this case, when you are dealing with the disallowable expenses, we start with the additional information. For example, number 2, we have been told that the cost of goods sold include the opening stock of 576, which was overstated. I said when you overstate the opening stock, you are making the cost of goods to be more. So in this case, reducing the reported profits. So we add back the overstated opening stock. So our overstated opening stock was how much? I can see we are being given 576. 576 we multiply by what? Which was overcasted by 20. It means 576 equates to 120%, but they overcasted by 20. So you just need the 20. So 20 over 120. So 576 times 20, I divide by 120, and I'm getting here 96. Then the next one will be, we also been told that while the purchases of 21 were inclusive of the VAT, so when you look on the VAT on the purchases, made your purchase to be more. So we add back because it reduced the reported profits. So the VAT on the purchases we have been told is 2146. We just need the 16%. So the 16%. So how is this going to be? So you just take 2146 times 16, divide by 116. I'm getting 296. 296 there. Then we are also being told that the closing stock of 675,000 were understated. When you understate the closing stock, it means also the cost of goods will be more, making the reported profit to be less. So here we discuss about understated closing stock. So the understated closing stock we are being told is how much? It was around 675. We multiply it by 675, we multiplied by, it was undercasted by 10%. It means this is equitable to 90%. What about the 10? So we say 10 divided by 90. So how much is this? So 6750 divided by 90, getting 75 shillings. Then we have been told all the revenues, that point is not having any problem with you. Number 4, we have been told that the salaries to partners, which we have said they are disallowable expense, we just add it back. So salaries to partners. Salaries to partners amounts to how much? 120. Then also we have number 5, the legal expense comprises of 1 is the acquisition of the company's title deeds. Acquisition of the title deeds, which amounts to 50,000. This is a capital item, so it is not supposed to be affecting the. It is not supposed to be affecting the. It is not supposed to be affecting the. It's not supposed to be affecting the income statement of the company. What I was not aware that there is no any student who have told me that Mwalimu, you have not allocated for the 3 months, but the opening stock is okay. When you go to the purchases, this is for the whole year. So 296, you multiply by 9, divide by 12. We are getting around 296 times 9 divided by 12, getting 222 here. So 296 minus answer, here we are getting around 74. The other one will be, the closing stock should be for the end of the year. So here is around 75. I think it was 75, our closing stock. Then also we have the salaries to partners. It should be on the side of the partnership. That is why we are not allocating it to the companies. Then we also have company title deeds. Our company title deed, we are being told, is 50,000. So ikiwa 50,000 should be affecting the company. It is not the partnership. So here is 50,000. Let us continue. I have done that correction. So the next thing should be negotiating a debenture stock. So the debenture stock should be, we are supposed to be assuming will be on the public issue. So the debenture stock should be how much? The debenture stock given should be 100,000, affecting the, I have done as an assumption it might be for the public issue, affecting the company alone. Then we also have demand letters to customers allowable, drafting of memorandum of association, drafting MOA. Our MOA is how much? We are being told is 60,000. So MOA should only be affecting the company, 60. Correct. Then in the next one, we are also talking about note number 6. Wema was paid a consultancy of 54,000, and we are being told that for installing a CCTV camera. So in this case, we know very well the CCTV camera, we are being told is 54,000, right? So the installation should be affecting the computation of the WTA for the cameras. We shall be able to incorporate that later. Then we also been told that advertising expense include a neon sign of 92,000. So here we have a neon sign. Our neon sign should be how much? So in this case, your neon sign should be, let me just check on it. We are being given a neon sign of 92. So 92 times 9 divided by 12, we get here 69, right? The difference should be 23. The difference is 23. Then we are being told number 8, the sales figure was inclusive of VAT at the rate of 16%. So if we overstate the sales, we said we overstate the reported profit. That amount, that computation is going to be done when you are doing the deductions. Now, when you look on note number 9, the direct allowances include commission paid to Nenda. So in this case, we have been told the commission of Nenda of 60 for negotiating a business contract. That is okay, it's allowable expense. Because if it was even a salesperson, ungemlipa that commission, so it does not have any problem. Let us go to the expenses. We have the purchase of CCTV cameras. We add back. The CCTV cameras, we add back, amounted to 96. So your portion, 96 divided by 12 times 9, getting here 72. On the other side, we are going to be having how much? So 96 minus my answer, we have around 24. Then also we have impairment loss. Our impairment loss is how much? Our impairment loss we are being given is 124,600. So impairment we just apportion 124,600. You divide by 12 times 9, getting around 93,000.45, right? Then the other one, the impairment loss was amounted to 124,600 minus my answer, getting that 1.15. That 1.15. We have website developments. Website developments. So the website development amounts to 130 times 9, you divide by 12, getting 97.5. Then the other one will be 130 minus my answer, getting that 2.5. Let us go to the other problem. We have debenture interests, which is okay. We have audit fee, okay, salary, direct allowances, legal. We have loss on rented property. So let me just put it here. Loss on rented property. So the loss on the rented property, we have how much? 36,200, 36.2 times 9 we divide by 12. We are getting 27.15. The other one would be, how much is that? The loss on rented property, that's 6.2 minus my answer, getting 9.05. Now, the next one we have purchase of foreign currency. Purchase of foreign currency. The purchase of the foreign currency amounts to how much? So our foreign currency amounts to 344.9 times 9, you divide by 12. We have 258. 258.675. Then we look on the difference. We have 344.9 minus my answer, getting 86. 86.225. The next one we have advertising, purchase of computers. Purchase of comps. So our computers were purchased at how much? 180. So 180 times 9 divided by 12, 135. 135 here. Here we have 180 minus my answer, getting 45. Yeah. The next one will be, we have insurance, medical bag charges, purchase and installation of computer programs. Programs. So the POG programs was 120 times 9 divided by 12. Here we have 90. And then here we have 30. 90, we have 30. 90, we have 30 there. So the only thing that is not captured there, nothing else. So what we need to do now is to look on deductions. So someone should be adding for 9 months. He will be able to give me total there. And then someone else to add for 9 months, 3 months, and give the totals. Yeah, let us less allowable expenses, stock non-taxable incomes. So in this case, we can start with the non-taxable incomes. And when I look on the income provided up there, let me look on the incomes. We have rental income. We just have rental income. Will allow me to push inside here. Rental income. So our rental income amounts to how much? 148.8 times 9 divided by 12. Our rental income 111.6. Then the other one would be, let me check. The rental income of ours was 148.8, and that's my answer, getting that 7.2. Then after the rental income, we also have foreign exchange gain. Foreign exchange gain. So someone will say it was realized. It was realized. So how much it is? It was around 120.2 times 9 divided by 12, getting 90.15. Then we also have 120.2 minus my answer. We have 30.05. 30.05. Then we have interest on fixed deposit accounts. Interest on fixed deposits. Our interest will be how much? The fixed deposits. So we have been told is 80. So ikiwa 80, you just need to divide 80, we are portion, sorry, divide by 12. Here is 60 and the other one is 20. Remember there was a computation for the VAT on sales. Our VAT on sales was amounting to how much? We have been told that the VAT on sales, the VAT was inclusive, the sales were inclusive of the VAT. So we are being given 5220. With this amount is 116%. What about the 16? So we multiply by 16 over 116. So 5220 times 16, you divide by 116, getting 720. Here we get 720. So 720 times 9, you divide by 12, getting 540. 720 minus answer, we get 180. We get 180 there. Then from there now we can do our capital allowances. And I'm going to be starting with the CCTV cameras. The CCTV cameras, we were told they were around 96,000. We add the installation fee of 54,000. Then these we multiply by 10%. 10% is for cameras under the WTA. So 96 plus 54 times 10, we get around 15. The answer is 15 there, which we are supposed to be apportioning. So 15 times 9, we divide by 12, here's 11.25. 15 minus my answer, we have 3.75. After the CCTV cameras, we have softwares. We have software, I think it was here somewhere. We have, let me see where they are. We have CCTVs. We also have websites. Do we have websites somewhere? Website development. Website development, it is 10% of the gross amount. So 10% of 97.5, I think I should be getting, let me just look at it. 130 times 0.1 times 9 divided by 12. You're supposed to be getting 9.75, correct? You can just do with this direct 3.25. Now, after the website development, we also need to have neon sign. Our neon sign was 10% of the gross amount. 10%. Let me see, the website development was how much? Website development was 130. Let me just put it here. Then the neon sign of ours amounts to, let me see, the neon sign was around into 92. So the first one should be, as per the neon sign, based on the computations which we have, should be 6.9 once you apportion, and then the next one should be 2.3. Once you finish doing that, we go to the next one. We have computers. I remember we had some computer programs. We had some computer programs. Yes, we had computer programs here. So COM programs. Our COM program should be 25% of 25% website development. This should be wrong. Our website is 25%. So 25% of 130, that's 2.5 times 9, divided by 12, 24. This should be 24.375. Then here, we are going to be having the difference, that's 2.5 minus my answer, getting 8.215. Then from there, we also have computer programs of ours amounted to our computer programs was amounted to how much? 120,000. So a quarter of this is 30. So 30 divided by 9 times 9 divided by 12, getting 22.5. Then the other one would be 30 minus answer, getting 7.5. Yeah. From the computer programs, we also have computers. Our computers were how many? We have comps here. Our comps amount to how much? Computers was amounting to 30. 180. So 25% times 180. So 0.125 times 180, we are getting 45. So 45 times 9 divided by 12, we are getting 33.75. Then 45 minus answer, getting 11.25. 11.25. Then from there, I think we have the neon computer program, so that I think we are done. So at the end of the day here, we can be able to get our adjusted business income. Our adjusted business income is how much? So let me get back here to you to see whether you're still following. So how much is the first one, please? For the 9 months, the totals which you are able to add these ones plus this one. How much is are we getting the totals? How much?
1,281.125.
Let me confirm that figure. Plus 258.675 plus 135 plus 90. You have gotten how much? You have gotten how much? Say your figure.
1,281.125.
1281.
Yes.
I'm getting 1280. Are we getting the same, Kevin? Kevin, what is your figure? Beatrice? Kuna mtu mwingine ameadd
1280.775.
1280.78 because of my space. What about the 3 months?
Joby.
3 months is how much? Someone? 3 months? Kindly? Three months is how much? Up to 3 months. How much is this? Please?
$640.6.
Sorry?
On 30%, it's 640.6.
I can't hear you.
Six.
639. 640.
639?
0.925.
92593. So what about the deductions for 3 months? Getting around 300.175. Once we subtract there, how much are we getting? So 276.375 plus 639.93 minus my answer. Here is 616.13. 616.13. 616.13. I think we have similar answers up to that point. Now, let us go now to the getting the adjustable taxable income. Adjustable taxable income. How are we going to be getting it? It's very simple. Because already we have already you have the adjusted business income. We just need to analyze the other incomes. Just need to analyze our other incomes. I think it will fit there. So when you look on the other incomes here, other incomes generated by our business, I can see we have interest on fixed deposits. So the interest on the fixed deposit, you are not going to be apportioning. That should be already affecting the company alone. Here is around 20,000. Why am I not adding the other incomes? If I was doing the partner's question purely, I'm not going to be dealing with the other income because the other incomes normally comes after the allocation schedule. Once you finish up to this point and you are dealing with partnership alone, then your question now you're supposed to be shifting it to allocation schedule. Now, to get our adjusted here, taxable income. For the 9 months, we have for the partners is around 120 or 1,209.38. And then for the company should be around 636. 636.13. 636.13. 636.13. 636.13. I know that you have written up to that point. You have written up to that point. I just want to go to, because already we need to do the, remember you are dealing with a company and a partnership. For the company, it should be having the tax payables as always. Let me just clear it here. So in this case here, we are supposed to be having one, we will be able to have the tax payable or tax liability. We are going to be taking the corporation tax rate, 30%. 30% of how much? 636.13. How much is this? 184. 184.84. We less the withholding tax relief. Our withholding tax relief amounts to how much? It should be the interest withholding tax relief should be 15%. Interest on fixed deposits. It will be 15% of the gross amount, which you have said is 20. So 0.15 times 20. We should be getting around 3 shillings. So once we deduct there, the tax payable here, the tax payable should be around 181.84. 181.84. 181.84. Let us go to allocation schedule. Let us now go to allocation schedule. How are we dealing with the amount for the partners now? So let us go there to the allocation schedule for the partners. Allocation schedule. We have only 2 guys here. We have Wenda and then we have Nenda. So just take Wenda We have Nenda. Then we have our total. Wema, Nenda, and then we have our totals there. What I could see from this question is that examiner has already given us, the salaries to partners. The salaries to partners were amounting to around 120,000. But this one we are going to be apportioning. The salaries to partners will be, the total is 120, but how they were sharing the profit and losses, so it will be 120 times, they were sharing is 2:3, so it will be 2 or 5. So 120 times 2 divided by 5, getting around 48 here for Wenda. So 120 times 3 divided by 5, getting 72. The total should be 120. The total should be 120 there. Then there is no anything. I have not seen there is bonus, commissions, interest, or drawing. We don't have all those. What I need to do is taking the profit sharing, stock loss, the profit sharing stock loss, and my profit sharing here should be, my profit will be how much? So the profit we were able to get it here. We got around 1209.38, and they are sharing these profits. Sorry, this is the adjusted business income. We don't know how much are they getting. Adjusted business income was amounting to 1209.38. 1209.38. To determine how much are they going to be getting each partner, the total here you're supposed to be taking the adjusted business income you have gotten, then you subtract what they have already gotten so far. So in this case, it will be 1209.38 minus 120, getting 1089.38. So in this case, you remember they were sharing their profits and profits and loss sharing was about 2:3. So to apportion or determine how much each partner is getting, you apportion this amount. So I multiply by 2, divide by 3, divide by 5, sorry. Divide by 5. This one should be getting around 435.75. The other one will be 1089.38 minus my answer. Now we're supposed to be getting 653.63. So how much each partner is getting at the end of the day? Each partner is getting, so let me start with this one, plus 72. This is 725.63. Then we have 48 plus 435.75, 483.75. Once you finish doing your question up to that point, then you normally go to other incomes, you apportion to each partner. So we go to other incomes. We go to other incomes of the business.
Excuse me, Mwalimu.
Yes.
I can't see that when you are writing. You hung up.
Okay, let me check. Sorry for that. Okay. Let me see. Is it okay now? I think it is okay. Now you can be able to see. Now we normally go to other incomes of the business. And one of the other incomes I have seen, we were discussing about the rental income. The rental income. The rental income, you do an assumption it is residential. So you put dash to each partner. Then we have interest. The interest on fixed deposits. For the individuals, remember these are individuals, the withholding tax at the rate of 5% is final. So in this case, you put that there, you put that and you put that there. What is the adjusted taxable income for each partner? Adjusted taxable income. Here should be 483.75. This should be 725.63. The total should be 1209. No, this is not important. So once you do your question, that is how you're supposed to be doing a question related to the partners. The interest on capital or the interest on fixed deposit to partners is not final. It means it is not subjected for further taxation. It is not subjected for further taxation. So let us do another illustration. I don't know whether you are done. I don't know whether you are done. As you communicate with me, let me just open the other question. Are we done? Just communicate with me through the chat box, please. If you are done, let me know. If you are through, let me know, please. So the profit sharing, I just took the adjustable business income which you were able to get was 1209.38. But remember, they have already been allocated the salaries, each partner. So what is the difference? What is the remaining for them to share? Because already we share lip 120. You just take 1209.38 minus 120. You'll be able to get the amount they are supposed to be sharing. Once you get 1089.38, the question already gives us the sharing, the proportion for sharing. They're supposed to be doing as 2:3. So once you take 2 divided by 5 times this, you're supposed to be getting this one. 3 divided by 5 times this one, you get that one. Then you do your summations accordingly. You do your summation accordingly. I think I'm clear, Beatrice. Thank you. Now, let us move to another illustration here. There is a good question they tested on November 2015. Let me just do this so that I can give you an assignment, which you're supposed to be sharing at the end of tomorrow for marking in our WhatsApp group. So let me see. Or individually, I think it will be better. Now, in this case, we have been told James and Katana establish a partnership business, sharing profits and losses in the ratios of 3:2 respectively. The following the income statement of the partnership for the year ended at December 2014. We have been given sales and realized foreign exchange gain, capital gain on sale of shares, all the way. Those are the incomes provided. Then we have been given expenses, and then our concentration now should be on the additional information. Number one, we have been told that the partnership was converted into a limited liability company. And we have been told that by the name Kaka Limited on 1st October. Remember also this goes for 9-3. Incomes and expenses were able to accrue throughout the year. Now, number two, we have been told that the purchases and sales were inclusive of VAT at the rate of 16%. Remember, the sales increases the profit, whereas the purchases decreases. The purchases are able to decrease your profits. Now, closing stock was valued at 1840,000, while the opening stock was at 10% of sales, net of VAT. Number four, we have been given that the legal fees was able to comprise of the petition to Association of Manufacturers, notice for change of business name, conveyance fee, stamp duty, negotiating a business loan, recovery of bad debts, signing a 100-year lease agreement, purchase of partners' private resident by James, and appeal against tax arrears. Number five, we have been told that repairs and maintenance, right? Repairs and maintenance comprised of purchases of furniture, installation of neon sign, designing an office block, cost of partitioning office block, and then we have repainting of business premises. Number six, we've been told general expenses included registering of patent rights of 64,000 shillings, floating cost of 48,000 shillings, and negotiating costs for an additional piece of land for business expansion at 56,000 shillings. Number seven, interest on loan includes interest on partners' capital of 100,000 shillings, while it was shared according to profit and loss sharing ratio. Require number one, a statement of adjustable taxable profit or loss for the business for the year ended at December 2014. We start with the gross profit. Number two, comment on the tax position of James Katana and the company. Then number three, citing examples, advise James Katana on 2 areas of tax avoidance that they should or they could explore for the business. So when we get this question, remember we have a partnership, and also we are doing what are we doing? We are also doing a limited liability company. Now, in this case, this question is tested differently from the one that we have already done. Remember, the examiner is asking you to now come up with the right income statement. So we are going to be writing our title, and we do our question concurrent. This is what we are supposed to be doing. This is what we'll do. So we have the partnership. We have James. What was the name? It was operating as James and Katana Business Sharing Profits. So in this case, we have James. The question was for November 2015. Question number 3. Now, in this case, we are being told we are doing James Katana, or what is the name of the James Katana? So we have James Katana and Kaka Limited. Kaka Limited. We have the period we are doing our question should be we are doing for which month or for which year? Sorry. It should be around 2014. So it will be 2014 taxable income. Remember, you're not doing an adjustment. Taxable income computation. So in this case, we are doing for 9 months. And also I'm doing for 3 months here. Right? So in this case, we start with we have 2 columns of Kenya shillings. We have 2 columns of Kenya shillings here. It looks like that. So the examiner wants you to start your question with gross profit. Examiner wants to do your question starting with the gross profit. I think that is the requirement. Yes, it is a requirement in the question. So we are going to be starting with the gross profits. Then from there, we have to do some workings to make our work easier. For example, we need to get the gross profit which we are required to apportion. So I'm going to be starting with my sales, and I could be able to see our sales are having some challenge here. We are being told in the question that our sales were inclusive of the VAT at the rate of 16%. That is the information provided. So in that case, we are going to be correcting that error, and we get back to 100%. So remember the figure provided in the figure provided for the sales is inclusive, which is 6728. We want to return this to 100, so we divide by 116 because this figure is equitable to 116%. So 672800, we divide by 116, we are getting around 5,800. From there, we less our cost of sales, and we are going to be starting with opening stock. So how much was our opening stock? We are being told in the question that our opening stock was around how much? The closing stock was valued at 18, while the opening was 10% of net of sales. So it will be 10% of the net of sales, which is 5,800. And this one you're going to be getting around 580. Let us go to purchases. So when you look on our purchases, we are being told that the purchases and sales were inclusive of VAT. How much was our purchases? And I could be able to see our purchases was around 2842,000. 42. We multiply by 100, we divide by 160 because we want to return this figure. This figure is equated to 116%. What about 100? We just do cross multiplication. So times 100, we divide by 116, we get 2450. Then we have our closing stock. Our closing stock should be how much? When I look on the illustration provided, our closing stock amounts to 1840,000 is provided in the additional information. So how much is our cost of sales? 580 plus 2450 minus 1840. We are getting 1190. Let us go to our gross profits. So we have 5,800 minus answer, which is 4610. So it means here, we start our question by subdividing 4610 to the periods. So 4610 times 9 divided by 12, our gross profit for this period should be 3457.5. Whereas 4610 minus my answer, we're supposed to be getting 1152.5. Then we look on whether we have some incomes relating to the business. And our incomes relating to the business should be, I could see we have an insurance recovery, as I could be able to analyze my incomes there. Kuna recovery from insurance on stolen stock. In this case, we add it here. Insurance recovery. Our insurance recovery amounts to how much? We can be able to see we are having 480. So you are portioned for 9 months. Here we get 360. I think here is around 120. What is our net profits? So it will be 3457.5 plus my answer, getting 3817.5, 1152.5 plus 120. We're supposed to be getting 1272. Then we less allowable expenses. Allowable expenses. How much is our allowable expenses? As per the question, we are being told, let us look on the right allowable expenses, which are already been analyzed as per the additional information. So I think from number 1 to 3, we are done with it. Then when I see the first problem which we are encountering in the question, it is the petition. We have the petition to association. One student will say, this was successful. Once you do that assumption, you put dash there, you put another dash there. If it was unsuccessful, put your figures there. All of you will be able to get the mark. Notice for the change of business name, disallowable. Conveyance fee, disallowable. We also have stamp duty, disallowable. Negotiating a business loan, disallowable. Recovery of bad debts, we say that the recovery of bad debts might be specific. So let me do that assumption. Recovery of bad debts. Recovery of bad debts, how much were they? I can see we're around 45 times 9 divided by 12. Here we are getting 33.75. On the other side, we are talking about 45 minus my answer. We have 11.25. Now, from the recovery of debts, we go to signing a 100-year lease agreement, disallowable. Purchase of partners, private residence, disallowable. Appeal against tax arrears, those are all disallowables. Let us go to number 5, where we are discussing about the purchase of furniture. We are calculating now the WTAs. We start with the furniture. The rate for this furniture, we are being told the rate as per the current rate is 10% of 96. This comes to 9.6, and then you apportion. So 9.6 times 9 divided by 12. Here we are getting 7.2. Then 9.6 minus answer, we are getting 2.4. Then we have installation of neon sign, capital allowance, 10% of the amount. So our amount amounts to 60, getting 6. So 6 once you apportion. So 6 times 9 divided by 12, getting 4.5. And then here should also be 1.5. Next one after the neon sign, I can see we have designing of designing of an office block, which is a disallowable expense. We also have cost of partitioning. Partition qualifies for capital allowances. Partitions, 10%. We multiply it by, where is it? So partitions, let me see. Our partition was amounting to 25,000. We get 2.5. Once we get 2.5 times 9 divided by 12, here we are getting 1.875. 2.5 minus answer, we are getting 0.625. From the partitions, we have repainting of business premises, allowable expense. So how much are we apportioning there? So the repainting of business premises, we have 22.4. We multiply by 9 divided by 12. You're getting 16.8. Yeah, we are taking 22.4 minus my answer, 5.6. From there, we go to the general expenses, which were including the registering of patent rights. We have flotation costs. When we discuss about flotation costs, we assume they were related to shares, right? So it is going to be affecting the company alone. When you do that assumption of 48. Yeah. We also have general expenses. Now we can be able to do them here. Our general expenses amounts to how much? We are being given the general expenses of up there in the income statement. Our general expenses we are being given amounted to 964. So I'll take 964 minus 964. We subtract the rest, right? We subtract what? That statement, not number 6. So we are going to be subtracting 64 minus 64 minus 68. Is it 68 or 48? Minus 56. So it will be 964 minus 64 minus 48 minus 56. We are getting 796. 796 times 9 divided by 12, getting 597. 796 minus answer, we are getting 199. From the general expenses, I can see we have note number 7. Interest on loan included the partner's capital. So in this case, we have interest on loan here. Our interest on loan, I can do a computation there. Because already we have to be looking on interest on loan in 2 ways. So we have 9 months. We have 3 months. Right? So remember, we have been told that the interest on loan, we have how much of the interest on loan here? We have around interest on loan. Let me check. The interest on loan was amounted to 166. So I take 9 over 12, 3 over 12 here, times 166, 200. So in this case, how much are we getting? For 9 months, we have 9 divided by 12 times 166, 200, getting 124, 650. Then on the other side will be 3 divided by 12 times 166, 200, getting 41, 550. 41, 550. But now, out of the 124, which we have gotten for the 9 months, we are being told there is a problem. Out of that amount now, interest on loan includes the partners. So out of the partnership, out of the 124, 100%, we just deduct it here, 100,000. And then we are going to be getting here 24,000, 24.65. Then the other one will be 41.55. 41.55. Then we are done with the additional informations. Now, from that point, we just go straight to looking on the other expenses which are included up there. And we have the purchase done with it. We have computers. So computers are going to be given WTA forms. The rate for the computers is 25%. 25% we multiply by 180. So 0.25 times 180, we are getting 45 times 9 divided by 12. We get that 3.75. 45 minus answer, we get 11.25. Then we go next here. We go next. Let us go next up here. So after the computers, we look on the partner salary disallowable. We have what? Legal fees. We were able to analyze repairs and maintenance. We analyze down. Rent and rates. Rent and rates is our another expense. Our ending rates, we are being given around 244,600, 244.6 times 9 divided by 12. Here we are getting 183. 183.45. The other one will be 244.6 minus answer, getting 61.15. After ending rates, we have interest on loan. We were able to work on it. General, we have worked on it. We have motor vehicle expenses. Motor vehicle expenses, we are being given for the motor vehicle 840 times 9 divided by 12, 630. 840 minus my answer, getting 210. Now from there, we go to insurance. Our insurance allowable expense, 156. So it is 156 times 9 divided by 12, getting 117. 156 minus answer, getting 39. From the insurance, we have preliminary expenses. They are disallowable expenses. We have director's fees affecting where? Director's fees, they are going to be affecting the company alone. So the director's fees is around amounted to 600. Correct. Then we have audit fees. Audit fees. Our audit fees was amounting to how much? So the audit fees I can see there was amounted to 148.2 times 9 divided by 12, getting 111.15. Then we also have the difference, 148.2 minus answer, getting that 7.05. Then after the audit fees, we have debenture interests. Debenture interest, which is also an allowable expense. So the debenture interest amounts to how much? 360 times 9 divided by 12, 270. 360 minus my answer, getting 90 here. Then next we have traveling expenses. Traveling expenses, 96 times 9 divided by 12, 72. 96, we get 24. So how much are we getting there? How much? Because what we are supposed to be getting here is normally called the taxable business income. The taxable business income. So let me start with the 9 months additions. 33.75 plus 7.2 plus 4.5 plus 1.8875 plus 16.8 plus 597 plus 24.65 plus 33.75 plus 183.45 plus 630 plus 117 plus 111.15 plus 270 plus 72. I should be getting 2103.13. Let me just round to 2 decimal places. We have 11.25 plus 2.4 plus 1.5 plus 0.625 plus 5.6 plus 48 plus 199 plus 41.55 plus 11.25 plus 61.15 plus 210, right? Plus 39 plus 600 plus 37.05 plus 90 plus 24. We are getting around 1382, sorry, 0.38. So how much are we getting there? So let me start with the second one. I take 1272 0.5 minus my answer, getting a loss of around 109.88. What about the other one? We have 3817.5 minus 2103.13. We are getting around 1714.37. 1714.37. The next thing that we're supposed to be checking on there, it is other incomes. And remember, it is going, the other incomes tunaweka tu kwa kampuni peke yake. Tumesema for partnership, you just go and add or after the allocation schedule. So in this case, the incomes which I can see qualifies for additional deductions. We are looking on the dividends from Kali. So in this case, I can see examiner is telling you that these dividends are for 51,000. But remember, 51,000 is for the whole year. So we just apportion 3/12. 51,000 we apportion so that we can get just for the 3 months. So 3 divided by 12. We multiply by 51,000. We are getting 12,750. So it's 12.75. 12.75. So the biggest question would be, what is the taxable business income? And I know some of you will be able to offset this 12.75 with 109, but your answer should just be 12.75. The reason being that, and we are going to be giving that explanation, that a loss from one source cannot be offset by a profit from another source. We cannot just be able to use this source to offset this loss. No, this loss should be offset by another profit from the same source, not from another source. Let me just calculate. When you look on the tax liability in this case, or the tax payable, the tax payable should be 30% of 12.75. That is what we're supposed to be doing there. But what the examiner wanted you to calculate was a statement of adjustable taxable profit or loss for the business for the year ended. We have already done that. Then number 2, we were being told to comment on the tax position of James and Katana. So the tax position, let me just list it here. Number 2, we have the tax positions, and we have said, for example, before we go to that tax position, let me just write this for you for clarification.
Excuse me.
Yes.
Excuse me. Mbona hatuja add disallowable?
Come again.
The disallowable expenses.
Why are we supposed to add them? Like, examiner amekwambia wewe mwenyewe calculate the right income statement. So sisi tumefanya with the right expenses. The disallowables, sisi hatujachukua the net profits. Hatujachukua the net profit. Tungechukua the net profit, examiner angekuwa ametupea that int. Tungechukua the net profit, we add the disallowables. But sasa ametuambia tuanze swali na gross profit, so we calculate per the expenses with the right expenses which are already recognized by the Income Tax Act. That is what we have done all through. In this case, I say a loss from one source, cannot be offset. A loss from one source cannot be offset by a profit from another source. Cannot be offset by profit from another source. It is however carried forward. Is however carried forward to be offset to be offset by a profit, to be offset by a profit from a similar source, in the subsequent years. From the subsequent years. Number B, we are looking on the tax position, and you can be able to say, under the tax position, I can be able to say, James and Katana will pay taxes. James and Katana will pay taxes on partnership. Together, will pay taxes on partnership income together with other incomes. Together with other incomes based on their PL, based on P and L sharing ratio, based on the PL sharing ratio. Then from there, we have said they will be taxed. From there, we say they will be taxed. They will be taxed on graduated. They will be taxed on graduated scale rates. And a personal relief will be granted. The personal relief will be granted. When you look on the other aspect is, the company will be taxed. The company will be taxed at a corporation tax rate. The corporation tax rate of 30% on dividends. Will be taxed on the rate of that percent of dividends only, and the withholding tax relief of 15% will be granted. The withholding tax relief of 15% will be granted. So that means that the business laws will be carried forward. Then number C, on the last one, citing examples, advise James and Katana on 2 areas of tax avoidance that they should explore to the business. So the tax ways, number C, we have been told the ways of reducing tax avoidance. The ways of reducing tax avoidance will be number one, that forming a business, they should be forming is just a one way. Forming a business as a company. They form their business as a company. Number 2, we are saying that they can also have some donations to charitable organizations. Charitable organizations. That is how you're supposed to be handling those kind of questions. So you'll allow me to give you some assignments. And these assignments I've said you're supposed to be sharing them tomorrow. So one of these assignments we have April 2022. April 2022, question 2B. That is one. Number two, we can also look on December 2021. December 2021, question number 4B. December 2021, question number 4B. You can just be able to go and look for those challenges there. Any question? So our next topic on Friday should be capital allowances. This is our next topic. That is our next topic. Next topic should be capital allowances. Capital allowances. Capital allowances. Thank you. I hope we have finished writing.